Money at Work Continuing Financial Education Series brought to you by Millionaire Mindset Life. Today's video is a financial coach's guide to navigating deflation. It's important to equip yourself with insights and then be prepared for all types of different possible economic landscapes we might encounter. Deflation is a term that's often overshadowed by its counterpart, inflation, but it is a phenomenon that demands both our understanding and our attention. In this video today, we're going to explore and break down what deflation actually is, its root causes, the impact on the economy, and various asset classes. We'll provide some historical context and perspective, the potential for deflation in the next couple of years, the Federal Reserve's likely response if that happens, and finally we'll end with some practical steps to safeguard your money and your personal finances in a deflationary time period. Deflation demystified. So there is a common misunderstanding about deflation. Deflation refers to a sustained decrease in general price levels of goods and services within the economy. While a modest decline in prices might seem like good news for the consumers at first glance, prolonged deflation can have severe consequences for the overall economy. So let's kick it off with the causes of deflation. In the world of economics, the term deflation signifies much more than just falling prices. It's a complex scenario influenced by many various factors. Understanding these causes is like peeling back the layers to reveal the actual core issues that shape economic landscapes. The fundamental reasons behind deflation are as follows. First of all, the demand side factor. This is the consumer's role. At its essence, deflation often starts with us, the consumers. Imagine a scenario where people suddenly cut back on spending. At the same time, businesses become very cautious about new investments. This collective pullback in the demands for goods and services sets the stage for prices to drop as sellers now compete for a marketplace of dwindling buyers. Second reason for or cause for deflation is the supply side shocks and, more importantly, the impact of innovation. Another force at play is the never-ending march of innovation. Picture a world like we have today where technological advancements have increased productivity, and that productivity has flooded the market with an abundance of goods and services. On the surface, that sounds positive, right? However, too much supply compared to a dwindling demand can lead us to a surplus, and we're right back to what we were just talking about. Sellers are going to try to clear that excess inventory, prices begin to slide, and we start this vicious cycle. Third cause of deflation is debt deflation. This is the balancing act with existing debt. Consider the influence of debts in this scenario. When individuals and businesses prioritize paying off their existing debts over spending, it creates a ripple effect. Reduced spending means less demand, and less demand contributes to that deflationary spiral that we've been talking about. It's a delicate balance between managing financial obligations but also understanding how those can inadvertently impact the broader economic landscape. Let's move on to the impact on the economy. When deflation makes its way into the economy, it affects carry through various facets of the economy. It's crucial to understand and navigate through these consequences, how deflation influences different aspects of the economy. First of all, we want to look at unemployment. This is the human toll of economic contraction. Deflation often emerges hand in hand with reduced business profits. As prices fall and demand weakens, companies may struggle to maintain profitability. This unfortunately can lead to difficult decisions, including layoffs to cut costs. The consequence is a surge in unemployment rates as businesses adjust to the economic downturn. For individuals and families, the personal toll of unemployment can be significant, affecting financial stability and well-being. Second impact of deflation is the debt burden. That's navigating the growing weight of the existing debt. In the deflationary landscape, the real value of debt tends to rise. As prices decline, the purchasing power of currencies increases, making each unit of debt more burdensome. Individuals with mortgages, student loans, or other credit card debt, and businesses with outstanding loans find it increasingly challenging to service their debts. This heightened debt burden can lead to financial stress and impact long-term financial goals. And then the third impact of deflation is on consumer spending. It's a ripple effect of cautious choices. In the face of deflation, consumers may adopt a wait-and-see approach. The anticipation of lower prices in the future prompts individuals to delay major purchases. While this decision might seem prudent individually, collectively, delayed spending contributes to a further decline in the overall demand. The resultant feedback loop intensifies the economic slowdown. And the fourth impact of deflation is the business investment. This is a stifled engine of growth. Deflation introduces uncertainty, especially for businesses. With the potential for lower profits and reduced consumer spending, companies may become hesitant to invest in expansion, innovation, or any new ventures at all. This hesitancy to invest can contribute to economic stagnation as the engine of business growth, it starts to idle, and that further impacts job creation and economic vitality. What is the impact on the US dollar and other asset classes? Understanding how deflation influences the value of the dollar and various other asset classes is crucial for formulating a comprehensive financial strategy. Here's an in-depth look at those impacts. First of all is dollar strength. Deflation increases purchasing power of money as prices decline. In a global context, a stronger domestic US currency is often seen as a safe haven, attracting foreign capital seeking that stability. A stronger US dollar can adversely affect exports, making domestic goods more expensive for foreign buyers. This dynamic may contribute to trade imbalances and impact industries reliant on those international markets. And then we move into the second impact, which is on the asset classes. And this is going to be various asset classes that we'll go through right now. Let's start with the stock market. Flight to safety is what you want to understand here. In deflationary environments, investors often seek safe haven assets, leading to a flight from risky investments like stocks. Companies may experience declining profits due to reduced consumer spending, impacting stock valuations and then shareholder returns. Real estate. Deflation can lead to a decrease in consumer purchasing power, affecting the demand for real estate. Housing markets may experience declining sales and prices. The real estate sector may face challenges as real value of outstanding mortgages increases, potentially leading to higher default rates. What about in the bond market? While deflation may lead to lower interest rates initially, prolonged deflation can result in increased default risk. Investors may seek higher quality bonds, driving up their prices and lowering yields. And then in the precious metals market, precious metals like gold may experience increased demand as investors seek safe haven assets. Once again, this scarcity and perceived intrinsic value of precious metals can make them attractive during these deflationary periods. And then finally, cash and cash equivalents. Investors may prefer holding cash or short-term instruments during deflationary periods to maintain flexibility and capitalize on the future investment opportunities. Let's now move on to some historical perspective and context so you start to understand past deflationary periods. Looking back at deflationary episodes such as the Great Depression provides valuable lessons. Governments and central banks implemented bold measures to counteract deflationary pressures, emphasizing the importance of proactive policies. The Great Depression, 1929 to 1933, the collapse in the stock market, banking failures, and sharp reduction in consumer spending contributed to deflation during the Great Depression. Unemployment skyrocketed, reaching unprecedented levels, consumer spending plummeted, and overall economic activity contracted severely. Stocks experienced significant declines, and real estate values plummeted during this particular period of time. Next example is the Japanese deflation bubble of the 90s and 2000s. Japan faced a prolonged period of deflation due to a burst of an economic bubble, leading to a decreased consumer spending and business investment environment. Japan witnessed an extended period of economic stagnation marked by low growth rates and deflationary pressure. The Japanese stock market struggled for many years, and the real estate prices faced prolonged declines as well. Let's move it back into the U.S. with the global financial crisis of 2007 to 2009. The subprime mortgage crisis triggered a severe financial downturn, impacting global economies. Many developed economies experienced deflationary pressures. Governments worldwide implemented stimulus packages to counteract the economic downturn. Stock markets faced significant declines, and real estate markets were adversely affected as well. What is the actual probability of deflation? As a financial coach, gauging the probability of deflation in the upcoming years involves analyzing various economic indicators and global trends. While predicting future economic conditions is extremely uncertain, you want to consider the following factors to provide insight into what might be happening or what could be happening soon. First of all is the inflation rates. Monitor inflation rates for the sign of deceleration. Persistent low inflation or deflationary trends in key economic indicators may lead us to the higher likelihood of deflation. And then second is consumer spending patterns. You want to observe consumer behavior and spending patterns. A significant decrease in consumer spending could signal reduced demand, potentially contributing to some of those initial deflationary pressures. Global economic conditions. Assess the state of the global economies, as the interconnectedness can influence domestic economic conditions. A widespread economic slowdown or recession in major economies may increase the risk of deflation. Number 4 is central bank policies. You've got to stay informed about policies of major central banks, especially the Federal Reserve. If central banks signals concerns about deflation and implement accommodative monetary policies, it may be a response to emerging deflationary risk. 5 is government stimulus measures. Evaluate the effectiveness of government stimulus measures. If fiscal policies fail to stimulate economic growth and consumer spending, the risk of deflation increases. And then finally, number 6, you want to be looking at interest rates. Consider the trajectory of interest rates. Central banks often adjust interest rates in the response to economic conditions. A sustained period of low interest rates may indicate concerns about deflation. If deflation happens, what is the Federal Reserve's likely response to deflation? In the event of deflationary pressures, the Federal Reserve is likely to implement a series of measures to stimulate economic activity and counteract those negative effects. Here's a breakdown of potential actions the Fed could take. First of all is interest rate policy. The Federal Reserve may opt to lower the federal funds rate to encourage borrowing and spending. Lower interest rates make borrowing more attractive, stimulating investment and consumption. Second thing they could do is quantitative easing, QE. The Fed could engage in quantitative easing, a policy where it purchases financial assets such as government bonds. The injection of money into the financial system aims to lower long-term interest rates and support lending. The third thing they could do is just offer that forward guidance. Federal Reserve may provide forward guidance offering insights into future path of interest rates. Clear communication about the central bank's commitment to maintaining accommodative price policies can influence market expectations. And then the fourth thing they can do is liquidity support. To ensure the smooth function of financial markets, the Fed may provide liquidity support. This involves making funds available to banks and financial institutions to prevent a liquidity crisis. And the fifth thing, while it's an unconventional and uncommon measure, is negative interest rates. Although unconventional, the Fed may consider negative interest rates as a last resort. This policy aims to incentivize spending by essentially charging banks for holding excess reserves. If we find ourselves coming into or in a deflationary period of time, how do we position our finances for deflation? Navigating deflationary periods requires a strategic approach to financial planning. Consider the following detailed recommendations for positioning your finances for a deflationary period of time. First thing you can do is understand the importance of the emergency fund. Ensure a robust safety net. Evaluate the sufficiency of the emergency fund based on your individual circumstances, taking into account living expenses, dependents, and potential disruptions in income. Ensure that emergency fund is easily accessible and liquid assets such as savings, money market funds, allowing quick deployment during any unforeseen financial challenges. And then given the potential for prolonged economic uncertainty during deflation, consider maintaining an emergency fund that covers living expenses for a longer or more extended period of time. Second thing you can do to prepare and protect your personal finances and money during these times is diversification. That's review and strengthen your portfolio. Increase exposure to traditional safe haven assets like government bonds, gold, other precious metals that historically have shown resilience during deflationary periods. Also consider reallocating portfolios to include defensive stocks from sectors like utilities, healthcare, consumer staples, which may be less susceptible to the economic downturns. And then also explore alternative investments such as real estate or hedge funds that have shown lower correlation with traditional asset classes during deflationary environments. The third thing you can do is start to manage your debt wisely. Prioritize reduction and refinancing. Conduct a thorough review of existing debts, prioritizing high interest debts for repayment. Assess the overall debt burden and strategize a repayment plan to get rid of it. Explore opportunities for possibly refinancing existing debt to secure lower interest rates. Locking in favorable rates can provide financial relief and reduce the overall cost of the debt and the servicing of that debt. Fourth thing that you can do to help out yourself is stay informed. Regular economic assessment. Stay abreast of key economic indicators such as, like we talked about earlier, inflation rates, unemployment figures, GDP growth. These indicators can offer early signals of potential deflationary pressures. Monitor government fiscal policies and central bank announcements. Policy shifts may provide insights into potential measures aimed at addressing deflation or stimulating economic activity. And then assess global economic conditions and geopolitical events. Global factors can have a significant impact on the domestic economic stability. The fifth thing that you can do, and the final thing that you can do, is just be adaptive and flexible. Regularly review and update financial plans based on changing economic conditions. Flexibility and adjusting investment strategies and financial goals is key to these uncertain times. You want to seek professional financial advice. Engaging with financial advisors, financial coaches can provide personalized insights and strategies as well as tailored individual circumstances and solutions. Understanding deflation and its potential impacts is crucial for guiding your money through these uncertain times. By staying informed, fostering financial resilience, and being proactive, individuals can navigate the challenges posed by deflation and position themselves for financial success in any economic climate. The following information is for educational purposes only, should not be looked at or taken as financial advice. Millionaire Mindset Life, stretch your thinking, create your vision, and achieve.